Good evening, everybody, and a very warm welcome to our second Brown&Co webinar for our Future Farm Resilience Fund delivery programme for Defra. We're going to be running for the next 45 minutes or so. We have two panel members who are going to be contributing this evening, and we would like to encourage as many questions as we can throughout this session. So we will record it, which is available to watch on YouTube afterwards. And just on questions, just so we can be clear, at the bottom of your screens, and we do hope this function works, you'll see a Q&A button. Please do pitch in there any questions you want to ask. We will answer all of them, either through the session or afterwards as a follow-up. There's also a chat button at the bottom there as well, and we will also introduce there any materials that we mentioned during the session, again, that you can watch afterwards. And we'll start by just putting the link to the previous webinar that we ran 2 weeks ago, which was our introductory webinar. So today we are going to focus on one of our specific interventions, which is very much around finance, technology, and collaboration. And I'm going to be joined by Charles Whitaker, sitting on my left here, who's the Managing Partner of Brown&Co, and also Chris Sheldon, who will join us in a little while, who's based in our Lincoln office. And Charles is going to be leading on the sessions on finance and Chris on the technology and grants. So we have a mixed audience tonight, and I think it's important that we just recap at some pace the overall intention of the project, so that everybody's up to speed, and then we'll go into more detail. So the Resilience Funds for Defra runs for the next 2.5 years until March 25, and it's intended to provide support through the agriculture transition. I suppose when it was originally put together, it was mainly around policy change, but we're seeing a lot more external shocks and challenges for farmers in the system now, and so hopefully it will help to support a much wider range of choices and decision making on farm. And this really sets out some of the reasons why we think it's important for farmers to sign up. It's a free service, and it helps to navigate some of the policy change. We know that over the next 3 or 4 years, BPS is reducing. It'll be 50% in 24, nothing by 28. We know that there are significant external shocks that maybe none of us could have predicted a year or so ago, affecting the market, input prices. We have new technologies coming in all the time. And this is alongside all of the more social aspects of the farming sector around succession and planning change between generations. And on top of that, we've got the climate that is becoming increasingly unpredictable with dry and wet periods, and the ever-increasing challenge of water provision on farm. So all of these we aim to cover in some of our interventions to try and help navigate pathway through some of these challenges. So just a couple of slides on, if you like, our pedigree and what we've done so far. So Brown&Co, we've been delivering this project right from the beginning. We started with the pilot phase, and then we went into the interim phase. In the interim phase, this gives some view of who we work with. So we work with all farm types: livestock, cereals, mixed and intensive. We worked across the whole of England. The project doesn't cover Wales or Scotland, and we have a good coverage, and we intend to stretch that further in this main phase. Half the farmers we work with were livestock, just over half had tenanted land, and we also work with about 1/3 of farmers who were 65 or plus, and I think that represents the demographic of the sector. So we supported 750 farmers through one-to-one on-farm support, and our model is very much around driving down farm drives, sitting around tables, walking around farms with farmers and their families. So what do we find from this interim? And I think this is important because this informs how we've designed this main phase. So here we found that around 86% of the farmers, and this was from our survey work, really set out that they wanted to or needed to make change over the next 3 to 5 years. A much smaller proportion, 34%, are doing anything about it at the moment, but they plan to in time. Profits, 68% of profits made up by BPS, probably much higher for many businesses. not a surprise. As far as opportunities go, a significant proportion of farmers thought that they might have buildings or land that might have higher value, either for development or for conversion or for doing different things with. And a significant proportion, 80%, planned over the next 7 years to undertake some family restructuring. It might be formal succession, or it might be just segueing younger members of the family into different parts of the business. A large proportion see environmental schemes as a low barrier to entry and have started to engage with it. So from this, we've designed our interventions in this main phase to give farmers choice. So all of those have informed the 6 or 7 interventions that we have around finance, around land and planning, around greenhouse gas footprinting, technology, supporting tenants, and then environment. And the next slides I'll just quickly run through. Before I do that, I'll just talk about Brown&Co. And I think what we bring is a group of professionals in-house across land agency, across agricultural consultancy, across planning and across environment, who can deliver specifically to those interventions. And we think that's really important, that we're able to match specialists to the requirement of farmers. And that's integral to our model. We're also working with a land agency partner in the Southwest to give us some greater local coverage in that area that we want to develop. So just to quickly run through the 6 or the 7 interventions, and this slide sets them out in a chart. Again, we'll just put this in the chat so you can have a look at it at your leisure. So there is a range here, and farmers' choice is really the motto of our project. We want farmers to choose which intervention best fits their scheme, their requirement. We're also offering some support activities around group learning, around online resources. We are going to use the new Brown&Co website to host some of the knowledge that we generate from the project. So that will be a resource that farmers can access. We're producing case studies and really just responsive to what's required going forward so we can share learning. So running through the interventions, the first one is an overall business review. This is what we offered before. The idea here is this will give an overview of business with signposts and action plans going forward. So this might be for new entrants who haven't done anything before, and we would see this as a starting point for many. The next one looks in more detail at finance, and this is what we're going to talk more about very soon in this webinar. And the second intervention after this also looks at technology and collaboration. Again, that's the focus of tonight. The third intervention looks at land and property, and this is looking through our planning teams at screening around local planning, around the potential on farm. And we believe this is important to de-risk decisions going forward. And our webinar that we're running on the 12th of December will go into this in much greater detail. The fourth intervention looks at natural capital in its widest form. Again, our next webinar, which is on the 1st of November in just over 3 weeks' time, we'll look at this. We're looking at habitats, particularly thinking about biodiversity net gain and enhancement. We're looking at woodland and carbon, and we're looking at navigating the options around agro-environmental schemes today and in the future. And we believe there's a whole lot in here that will be of interest to farmers. And this links to our greenhouse gas footprinting option, which is also on offer. And again, we see quite high uptake and a lot of interest in this one already. Could become a requirement driven through supply chains in the not too distant future. And this will give a baseline for farmers and try and bring in some practical discussions around some of the trade-offs around reducing greenhouse gas footprinting alongside ensuring that the economics of production remain. So this will tie in with the environment webinar in 3 weeks' time. And then our last focus area really builds on work we've done before with tenants. and we worked closely with the Tenant Farmers Association in the past, and they had helped support the focus of these interventions. So this is going to be delivered by our land agents and will be more of a discussion. And this webinar is on the 23rd of November. And it ties in nicely with the ROC report that's just come out around looking at the tenancy working group and some of the challenges tenants and the mechanisms for tenants face in the light of the new policy reforms. Okay, so I think that's a rattle through where we have been. So the links and information on our first webinar, where all of those were talked about in more detail, you can see in the chat. So what I'd like to do now is to move on and spend most of our time in this session looking at our interventions on finance, technology and collaboration. So the first area is looking at budgeting and business planning. And the way that we've designed our intervention is to allow farmers choice. So there are 3 different tools within here, and any one of which farmers, landowners could choose to work with us on. The principle being that there's roughly a day of time that goes into this, into our support. So if we go to the next slide, this first one is the first one of our tools, and I'm going to hand over to Charles and ask Charles just to talk through who this is for, what problem this is trying to address, and really, why this could be of interest for farmers within this project.
Thanks, Greg. Good evening, everybody. Yes, I think just a bit of background around net enterprise margins. All of us, certainly from my own point of view, the last 30 years have been schooled in gross margins, and gross margins have been a typical measure that lots of us involved in the industry, whether it be producers, some of the university costing schemes, and much of the teaching has been our gross margin. And what we've seen, of course, over particularly the last 2 years of volatility, extreme volatility, but even before that, over the last decade, I would say, is that a need to focus much more on net margin generation, particularly across a business, onto the individual enterprise within a business. Not that straightforward to do, it's fair to say, but I think given what's now happened to direct cost of production, variable costs, perhaps seeds, ferts and sprays, an arable situation, and the operating costs, OPEX as we might call it, being fuel, repairs, depreciation and labour, those costs have all ballooned enormously, obviously since the war in Ukraine, but even before that, those costs have been probably doubled in the previous 10 years, and they've not far off doubled again since the Ukraine conflict in certain cases, like fuel and fertilizer in particular. Now, because of that, the impact on individual returns from individual positions in a rotation or competing crops and land uses on a particular rotation, a particular holding, those net margins have changed substantially, as most of us will know. And what this tool seeks to do, and this intervention seeks to do, is spend some time looking perhaps at past, what's happened in the past on a farm, what's happened on immediately available financial records. Often that's the set of accounts that are available, but we can quickly also assemble the basics of what's happened in the current financial year. But what this net enterprise margin seeks to do is to look forward. So now we're obviously looking forward to the 23 season, the 23-24 financial year for a March year end. And this seeks to look forward, preferably before decisions are made about cropping, to see what the differences are that we've now got to deal with nitrogen perhaps at £900 a tonne, whereas last season it might have been 280, the previous season it might have been £180 a tonne. That makes an enormous difference to net margins on certain crops. And a big focus for us has been with our regular clients, and through this FFR phase 1 delivery, has been, have we got positions in the rotation or areas of our land use which are contributing negative or near negative net margins? Because clearly if we have, there needs to be a very good reason why we're still doing it, or what can we do instead of that, and how can we change the lineup of land use on a particular farm and make step changes to fixed costs, perhaps operating costs, and get greater contributions to the bottom line. So that's a bit cluttered. That table on the left, that's an Excel sheet with a various series of macros which help us to allocate fixed costs with the farmer during the meeting, and based on our knowledge elsewhere across those enterprises, not just a straight line allocation, but a more scientific allocation, because we believe that's very important looking forwards. What the table on the right-hand side seeks to do is to, the first, at the top of that page, it seeks to look at, okay, how does that look typically? And I think the example we've got there is across a whole holding for 23-24. Obviously, we've all seen a very significant increase in most commodity crop, broadacre commodity crop outputs, which are far higher than they would have been in 21 or 2020. Not all, I might add, but most. But we've also seen a big increase in variable costs or direct costs. And this is really to look forwards at what net margin are we generating post paying all the bills effectively. And therefore, you know, what have we got for capital investment, paying down debt, paying drawings, etc. And the bottom table there just seeks to show in 2023, the 23 harvest, 23-24 financial year end, what the likely contribution is based on various assumptions, which we'll make on that table on the left with the farmer, as to what average yield potential has been, what the price predictions are, and we can see those now for the future, and what the costs are we're going to incur in getting there, basically. And one thing we've seen massively between certainly 2021 and 2023, forgetting the current year, which has been a peculiar year, half built with lower cost pre-Putin and half higher cost post-Putin. So a bit of a one-off year, I would say, in net margin terms. But looking between 21 and 23, we've seen huge differential in these net margin deliveries, particularly because of nitrogen price, obviously, for 23, and operating costs. Fuel has doubled, nitrogen has trebled, and therefore, for the net margin lineup between crops is very different. As you'll see on that table, bottom right-hand side, spring beans, you know, really making no net margin at all. Probably most of us don't need us to tell you that or tell us that. We've got it there for a rotational position, but in many cases, vining peas will be another one. Sugar beet in the past, I'm sorry to say. So we've got this price rise to put it back on the leaderboard as being a deliverer of no net margin. So why are we doing it? Farming is an expensive business. It's a risk business now too, because of this cost structures in place. And so this seeks to try and get through the weeds of that to help make decisions about future land use on farm, basically.
And just to add to that, I think Charles would agree. One thing that this tool can bring is some agility, because you can play around with it. You know, you can look at different options, and it's a rapid assessment of it, which you can do with with the advisor as part of this delivery. It also allows you to look at the options for things like stewardship and see how they might stack. Obviously, there's a discussion there about how fixed costs are allocated with stewardship, but that allows that to come into the mix to understand, particularly on the not so good land, whether that's an option and stacks up against other margins as well.
Yes, we're going to make changes to land use that involve changes in lumpy fixed costs like numbers of personnel or numbers of tractors or other fixed costs. This tool allows us to plan for that and help to work that through. It's not a 5-minute job. It's a day's work, but a collaborative day. And we found it very useful. And we certainly, in all our consultancy work, we've moved very much towards a net margin assessment rather than gross margin assessment, because we feel it's vital at the moment.
So this tool really is for cropping. So it's arable and it's root crops. The next tool that we're going to move on to has applicability for livestock and brings in cash. So this is our our budget that we're offering through this through FFRF.
Yeah. So thanks, Greg. So what we're seeking to do with this budget is, again, it's not a quick process, but we're seeking to build a budget looking forwards as part of this day's intervention as to what's happening to profit, as we've just been talking about, and net margin delivery, but also, as in more importantly perhaps, what's happening to overall annual profit and cash movement in the business looking forwards. Again, I alluded to last time, we've had this massive increase in the cost of farm production across all sectors, whether it's feed, fuel, fertilizer, energy, everything, or cost of equipment has moved up massively. We don't see that changing anytime soon, unfortunately. And so this tool allows us to project forwards on an annual basis, producing 12 month cash flow, producing annual profit projection, and working out where our net profit is going to be in this year ahead, and what happens to our cash. As you can see on the top right-hand side of that, we have a model farm, Brown's Farm, which we model all the various policy changes that are coming through, and the crop pricing change in input costs to livestock and crop systems, and we've used that as a base illustration base here. But this would be your business, your data, your budget, really, and producing it collaboratively with you around the table is the plan. This is what we would seek to do and normally do. The output of that, and there's many pages to this budget model, but this particular output is source and disposal of funds, and really is seeking to demonstrate what's happening as a result of this annual farming calendar tied up to an annual financial year, what's being generated in terms of cash, because cash often said is king, and it certainly is going to be going forward because of this increased cost of agriculture and increased volatility and risk. So the bottom right-hand section of the right-hand column there, 82,308, just about read it without my glasses, is a cash decrease for the year as a result of, yes, we're generating 100,000 of profit, top left, but because of what's happening through reinvestment drawings, lease HP repayments, and increasing valuations, that stock on the farm, we're actually decreasing the cash. Not a problem in itself if we're increasing £119,000 worth of stock, but it is if we don't have the facilities to support it, and it's better to know that in advance, obviously, because things are changing very much around the cash requirements of agriculture, and I suspect in the banking sector as well, as to their stress testing and looking at how businesses are performing in this new environment that we've got. So we find this whole budgeting tool extremely useful across our main business, and our clients do too. We do it every single year for all of our management clients, and that's what we're seeking to offer within this intervention. So just on the top right, where we've got that highlighted, this cash decrease in this particular case, as I say, because this particular farm example is holding stock for the year, which, as it turns out, would have been a very good thing to do last year, given what's happened to crop prices if we're into crop production. But it also has this debt service coverage, which is a test that many farmers will have started to become familiar with. Banks in the past, and we might have talked about loan-to-value ratios, and we still do talk about loan-to-value ratios, important, but of course in tenant sectors that's becoming more and more challenging, and that's another reason to have this budget done, I would suggest. But the debt service coverage is really the ability of the surplus cash being generated in the year, or profit being generated in the year, adding back depreciation, because you don't have to spend that every year, obviously, adding back funding charges, so earnings before interest, tax, and depreciation effectively, how that can deal with drawings, reinvestment of capital, HP repayments, loan repayments, and tax and interest. And that debt service coverage is a test that banks are using a lot now, and have been it's been around for a few years, but it's becoming more and more commonplace, I would suggest. And it needs to be a positive number over 1. So you need to have more than 1 times coverage of the ability for the EBITDA really to fund those other costs of reinvestment, HP and loan repayments, bank interest, etc. And drawings, of course, we've got to live and pay tax. Typically, I would say banks are usually asking for 1.2 to 1.4. In agriculture, that's quite challenging, especially if you've got heavy loan repayments structured into a business. We try to get it to 1 to 1 because agriculture doesn't traditionally generate huge profit surpluses to deal with paying back debt. And if you happen to have a 10-year or 20-year debt repayment in the business, it's quite challenging if you've got a very tight debt service coverage ratio. Also within this model, again, it's a live model worked out on the farm on the day with the participants. We've got the ability to flex and stress test the interest rate. Obviously, a hot topic at the moment. It's been a difficult few weeks, obviously, for those of us that have got variable rate debt on farm. And this allows us to plug in the rate we might have on various different loans and the overdraft, but it also allows us to flex that to see what we can stand really about base rate movement, because again, being in front of that dilemma and in front of those challenges and able to make plans ahead of time, whether that's sales timing for livestock or stock, whether it's releasing capital from some other assets that there might be, rather than waiting for the debt to be a challenge and overdraft facilities to be a challenge and having that dictated by funders. So that's really a key output from this exercise. And then this proportional analysis below, again, that obviously changes significantly for different types of business. We look at intensive poultry business, for example, versus an arable business or a ruminant livestock grazing business. Those numbers will be very different. But again, it's for each of the types of farming entity, we've got target margins and target proportions to aim at. And this really then seeks to say what's happening in this business in this particular year against those targets.
And I think that's a really important point, and certainly feedback we had last time in working with the 750 farmers in the interim was a request to try and get some comparables in the figures so that generally businesses can understand where they sat versus others. And we'll talk a little bit more about that in some of our interventions going forward.
The last point I'd just make about that, Greg, sorry, I forgot to mention it. I think the important point about all of this is looking forwards, A, because things are changing rapidly in the industry and the commodity markets and the livestock sector too, and costs, but B, so that we're not waiting for accounts March year end, such as this example. We probably have accounts possibly in September or October now, and that's looking back to the 21 harvest or 21 production year ending in March 22. We want to be looking forward. So this is a projection for the 2024 year end as what that's going to look like. So we can influence or help to provide influence and decisions and about change well ahead of time rather than looking backwards all the time.
I think to add to that, one of the challenges I found in the last phase was that we were looking at accounts information, which is historical, often to harvest historical, and things. The world has changed a lot in that timescale. So one question, just before we move on to Chris, one question that's come up, Charles, is just around how farmers can be used the time most efficiently, because there could be a lot of information here to prepare in advance. Maybe how might you advise those taking up either the enterprise margin or this one to prepare in advance?
That's a really good question. As we all know, time is a biggest challenge, and those who were fortunate or unfortunate enough to have me on the class phase will know that time is a serious challenge, particularly for me. But that's a good point. So I think preparation of data, we probably get a bit smarter about what we're requesting farmers to have ready for this exercise. That said, I do think there's a lot of value in having a bit of calm time, looking around the farm, this is the first time we might have met, talking about the family, the farm business structure, the history, to get a bit more knowledge around the generalities of that business rather than just sitting down and bang, bang, bang into figures. We've got to have some of that time, but really having past accounts available, any crop recording or livestock recording systems, management information available that might give us inputs, levels of feed or overheads or variable costs in arable operations, so field records, that sort of thing. Obviously the next year's production plan, livestock numbers, year-end numbers for livestock, the opening year-end numbers for stock and livestock and cropping, and all of the relevant bank balance, loan balance, HP data available. Most of us are going to have that in our farm office somewhere. But yes, we probably could produce a checklist that might help people prepare for that. That's a good idea.
Yeah, and I think key to getting the most out of this program really is preparation, because we on farm would much rather spend our time talking through some of what we're finding rather than actually digging out the information. So using information rather than finding it from first principles, I think, is really important. Obviously, we can still do that, but that's the way to get the most out of the time available in this Defra project.
And the objective being for us to produce this together on the farm on the day, because then we can discuss its outputs rather than it goes off and a couple of weeks drift by and we've got to try and arrange how do we get that relationship back again to go to the outputs.
Okay, do keep firing in questions, please. We will, any that come up that are relevant, I'll answer or ask Charles to answer as they come up. So please feel free to keep sticking them in the Q&A. I'm going to move on now. We'll come back to Charles in a bit to talk about collaborations, but I want to move on now to our next slide. And this really looks at the third of our tools that can be used either to look for new diversifications, new enterprises, or it can be used to look at the potential for technology adoption. And I want to bring in Chris Sheldon here, who is going to run us through this slide. Chris?
Hello, good evening, everyone. Thank you, Greg. Join you today from slightly breezy mid-Lincolnshire. So I'm just going to run through the next few slides as Greg and Charles have just done there and really try and build on some of that in a way. We know, if we're brutal about it, that the UK is slightly behind some of the other agriculturally producing countries in Europe and the rest of the world. We know that we're moving from a supported industry in the form of basic payment to an unsupported industry, as they are in other parts of the world. So we need to, as many people will have read and heard about over a number of years, try to, where possible, increase our productivity and efficiency as an industry in this country. And what we're going to aim to do with this intervention is actually target some of that previous information you've just heard from Charles. So yes, we can do a budget for the whole farm or net margins for use of land, but if you're there as a farmer and a farm business and looking at efficiency and productivity, how are these things going to make sense to you? So really, I just want to run through quickly some of the things that I've seen and we've seen over the last few years that people have actually invested in when looking for productivity and efficiency gains. So if you'll humour me, I've got a list here. So in livestock, in the livestock world, robotic milkers, producing meat on farm, selling it, direct sale to consumers, in-house butcheries, milk processing into other products and cheeses. We've seen people looking at performance recording technologies in livestock and pasture utilization technology as well. In the arable world, we've seen grant funding for direct drills, GPS equipment, things to do with sprayers, making pesticide application more efficient and targeted. We've seen slurry application and organic matter rising up the agenda as well. We've seen camera guided equipment really start to come forward as the technology improves, and some of those pictures on the screen there sort of demonstrate all of these. We've seen arable farmers doing the same as livestock farmers, so processing their own produce or utilizing redundant arable buildings into other diversification projects. And then especially in the specialist crops sector, labour has become a huge issue, and if there's any of you watching from the specialist crop sector, that will certainly hit home with you. We've seen an enormous increase in people trying to automate their systems for processing and packing, and investing in robotic technology where possible, because a robot doesn't have days off sick or not turn up for work generally. We've also seen optical grading, so we've not got tens of staff grading out produce where necessary. And we've also seen people really bringing water and availability of water up their agenda as well. And that can include technologies like weather stations and moisture probes, as well as investment in water storage and use. So that's a huge list, I know, but hopefully that those of you listening can relate to some of those investments and start to think about how that can affect your business and improve the productivity and efficiency of your system. So what we're going to do here is, obviously on the left, you'll see that the problem, there's all this stuff out there. How do I access it? And what should I be doing? So we have a partial budget tool, which we'll come on to in a second, and work out whether there is a practical solution when it comes to adopting some of these things. And then we'll go into understanding and working through with you the risk, the return that might be required with some of these technologies. So if we want to move on to the next slide. So the partial budgeting tool, as Charles said earlier, we can get figures from accounts or accounts packages and use those. But when we're actually looking at a really narrow investment, so, okay, if I spend X on something, how is that going to either cost me money, save me money, etc.? So with this, we'll plug in any costs that you've saved as a result of your investment, any additional income you've gained from that investment, additional costs that you've incurred, and any income that you've lost. And then that gives us a really good idea of the financial impact of your technology or productivity investment, a return on the investment, and a payback period, because we need to understand those before we go on to spend the money. So a really good example here is a reservoir. So especially, I mean, we've even seen this summer broadacre arable crops being irrigated in some parts of the world, and water being high on the agenda. And I'm sure Charles might come in at the end and touch on water in other parts of the world that he sees and how they adapt, possibly, if we've got time. So we want to make sure that our capital at stake is used wisely. If we're borrowing to invest in these productivity and efficiency gains, that's done well as well. So, you know, investment isn't easy at the moment, and we need to properly narrow this down and put figures to it where we can. Okay, so grant funding, you know, some of this kit is really expensive, and we need to make sure that we're actually investing in the right way. And these grants have been really useful in the past to help us do that where possible. And I think that you know, we've done somewhere between 30 and 40 million of funding that we've helped people gain, and there's going to be a new rollout of some of these funds now, which are all on the screen there, and we think that this will continue for as long as the BPS keeps reducing. That spend will be rolled forward. So this is a really good way of reducing the risk to your business and adopt a grant where it can be done. So I'll leave it there for now, and if we have time at the end, I'll come back on grants and give a little bit more information on what we can actually do as part of the Defra project to help you gain a grant where it's necessary or where it's useful.
Thank you, Chris, and nice to hear a little bit of support from your dog in the background that was cheering you on, as ever. Good on him. So just to make a point, I think on the earlier slide, you talked about all those technologies. I think it's an important point here that we've been involved in grants for a lot of those. So there's a whole breadth of grant process that we can bring, and we can offer that insight to, you know, farmers, landowners who want to take up this service with us. I think that's an important point. They're not just a list of technologies we happen to have found somewhere. They're very relevant for what we have experience within. Okay. So,
yeah, I'll just add to that, Greg, quickly, just while I think about
sure.
it, that what we have done with people in the past is sort of gone through. You've just jogged my memory there. That we will go through and decide, okay, is a grant possible for some of this stuff, and the time frame, the requirements, and so on and so forth. So we won't let you go ahead with a grant unless we're confident that you're going to get it.
Yeah. And equally, we probably will try not to let you go ahead with the investment if we think we can get a grant until we've got the grant buttoned down.
Yeah. There's one or two questions that are coming on grants, Chris. We'll come back to those. We'll just go through the collaboration area with Charles now, and then we'll come back to that. Just one question I do want to answer now that's come in that's important, I think, just to make the point on around data confidentiality, and particularly relating, I think, to some of the financial information. Now, there's been a question around, you know, does Defra see any of that data, any of that on-farm finances? The answer is absolutely no. The intervention is confidential between the advisor and the farmer. Nothing goes to Defra, and I just want to make that point. And that was a question well made by one of the attendees. And the third part of this session is really looking at collaborations in their widest form, but we want to hone down a little bit on a couple of examples that we've worked with. So, Charles, if you could talk a little bit about collaborations.
Yeah, and just to pull up on that data point as well, I don't know which direction that question was coming, but I think, you know, bear in mind we're a reasonably sized business. We've been doing farm consultancy for 30 years next year, actually, our anniversary year. And I think, the ability to remain private and confidential with everything we do, with all of our clients, whether it's through their service or anything else, and all of their data is clearly absolutely paramount to what we do. We obviously are in a very privileged position, involved in some big complex businesses, and clearly we have to have the capability, and the clients have to have the confidence that we keep that information private to them and nobody else. So that sort of goes without saying in our territory at the end, but it's important, especially for people we don't know and don't know us.
Absolutely.
So collaborations, yes. I mean, obviously, for those 30 years and a bit more than those 30 years, we've seen various forms of collaborations come and go across the farming piece, I would say. Share farming, big thing, back in the late 80s, early 90s. IACS and BPS sort of knocked that on the head because of Defra getting hung up about sharing occupancy of land in one way or another, or indeed of the production methodology. We think share farming probably deserves a bit of a refresh. I think in some parts of the country that's happened to an extent. We've got a few livestock examples where it's happened. I think, I must admit, we had thought internally, and I had thought certainly up to Putin and probably up to the 21 harvest, that because of the very constrained margins across arable agriculture in general, that perhaps we would see a tapering off of the demand for contract farming and more share farming types of arrangements for a number of different reasons, not least the cost structure has been baked into some of these contract farming arrangements. I think actually now we've got bigger surplus, that's what's gone away, and I think there's a slide to demonstrate that in a minute. So yes, in terms of collaboration, I suppose why collaborate at all, and perhaps we haven't got a great press of farming in the UK for great collaboration compared with some of our European neighbours. And I think we've seen some tremendous examples of that. Perhaps Arla would be at the top of that in terms of farmer cooperative, but just more down to earth, practical, operational collaboration. We've got an ageing industry, and none of us can do much about that apart from encourage next generation. But where we've got farm holdings, whether we're tenants or whether owner occupiers, and we're advancing in years and can't physically do what we might have done 20 years ago or 30 years ago, there's a need for collaboration right there, because we've got to get the operation done. We perhaps want to inject some more youthful enthusiasm and energy and time, quite apart from anything else. So that's one fairly obvious demand for collaboration. Don't forget, in many tenancies, even AHAs, there's scope for us to work around some of the tenancy restrictions in some cases in order that we can keep farmers on holdings, keep people in houses, but have perhaps some of the work done with somebody else, obviously subject to what the tenancy says. And that's why the land agency intervention here is quite important, and why tenants are a particular focus, particularly when they might be coming to the end of their careers, and particularly when they have difficult relationships with some landlords. As I say, contract farming has been around for a long time, along with share farming, where effectively one part is providing operational muscle, if you like, and capital by way of equipment, and time and labour to do the operations of the farm, and the other part is providing the land and facilities, and that might be an owner or a tenant, with the caveats around tenancy restrictions, obviously. And that has worked pretty well over time, providing they're set out in the first place with fairness and equity in mind. I don't think any of these things are a way of screwing something out of somebody that's not going to be seen to be reasonable looking back, and providing the chemistry works between the parties. I think for most of these we're talking about normal sized businesses, and generally we are, I think we're generally talking about businesses of sensible size, not massive businesses where this is applicable. Might be sole trader proprietors, might be family partnerships involving one or two members of the family. It's essential that there's some chemistry and trust between the operating, or between the relationships, otherwise it's not going to work, frankly. And out of all the ones we've been working with for 25 years plus now, same farmer, same, or maybe just member of the family, same operator business, trust is absolutely essential, as is a fair structure. None of this is really a way of, well, how can I get a massive rent agree while commodity crops are high and sit back and wait to see what happens in the next 5 or 10 years. Maybe people end up with that around tenancies, some of the FBT rents you might have seen in the last 7 or 8 years. But I think this is really about, we think anyway, long-term collaboration, choosing the right partner and the right structure, where we're perhaps injecting innovation, technology, greater level of expertise, different level of expertise, different generational expertise, different generational approach, and where we've got a resource, a land or a property, a building property resource, where we need some other ingredient to get the most out of it. Obviously, it can be a great way of releasing capital on the part of the land provider as well, whether that be machinery and equipment, whether it be working capital to fund the whole of the farming year, in the case of a tenancy, obviously. let's say for contract and share farming. And we've also seen some very good examples over the last few years of machinery sharing and cooperative arrangements, which have worked pretty well. Again, providing they're structured correctly and with a very high capital cost of equipment now, particularly at the larger end of the scale. You know, the opportunity to utilise that equipment across a broader footprint or sharing where individuals can't justify the investment in that technology has been a source of those, I would say. Yeah, I don't think there's much to add about that. I mean, so down the bottom there, managing succession, it can be a great way to manage succession as well, where easing out of full-on operational roles is on the agenda because of health, age, other objectives, other business opportunities to pursue. So it can be a great way to do that. But I think the most important thing on all of this is equal ranking, fairness and trust, and that relationship between the parties.
I think the next slide just shows a couple of examples that we can just quickly run through. Then I want to get into Q&A. So
yeah. So in this on the left-hand side of the page, we've got a couple of again, I think share farming is going to come back. We've had a couple of examples in the last, well, since Brexit vote, I would say probably, and since Brexit, of where there's been concern about livestock net margins. We've been concerned about it, clients have been concerned about it, and where we've needed to inject significant change in perhaps loss-making livestock enterprises within a bigger business or the whole business. And share farming, we've got a few examples in ruminant livestock where that's worked extremely well, where the collaborator or the operator side of that equation has maybe got some stock somewhere else or nearby, and we've been able to marry up with another enterprise on a farm. So we've got 2 and 2 making 4 in terms of scale, and then we've had a different operating model by way of labour input, etc., where people are effectively self-employed as the operator, working for themselves with their own incentivised returns, and we've just found that works very, very well, particularly on some lowland sheep flocks that we've been involved with in the last 2 or 3 years. On the right-hand side, I just set out a couple of examples. 1,000-acre, 400-hectare arable contract farming businesses have been involved with for 25 plus years, as I said earlier. And what's happened because people might be concerned about net margin with these enormous costs we're facing at the moment, and they are enormous, between 2020 and 2023, and that's a graph of return per hectare for the landowner or land provider and the operator. And we can see this 2022 bonanza year. Forgive me for some of those listening that won't have had a bonanza year in pigs, poultry, beef, and several other sectors. But generally on the arable side of the country, despite the terrible drought conditions that have been, 2022 has been a big year, and we can see that leap. But as we face 23 with doubling of fuel, trebling of fertilizer, a machinery that's sort of off the scale at the moment, we can see the net margin is still sustained at a decent sort of level of £400 to £500 a hectare for both operator, which is where it needs to be, and for land provider. But the working capital cost has risen significantly. In these particular examples, 1,000-acre contract farming, I would say the working capital is at least 100,000 more because of what's happened to this operating cost.
So I think, and this will answer one of the questions that just come up. You know, what does this Brown&Co Future Farm Resilience Intervention help farmers do in this area of collaboration? I think there's probably a couple of answers to that. One, you know, we could sit down with farmers who want to collaborate and facilitate discussion, facilitate the meeting. That's something we're very happy to do with the background information for that. Or we could sit down with farmers, landowners, and run through the range of options and work through, you know, the pros and cons of each with some figures that underpin them, so that we end up with, you know, a preferred option. And there might be a next stage beyond that then to actually take that forward. And I think key here is understanding what farmers' ambition is and agreeing that at the beginning, and then we could be flexible to tune our intervention to deliver to that. There are two more. The last slide here, just before we go on to the Q&A, is looking at 2 additional tools that we offer. Again, these could be standalone, or depending on time input, they might be included with other parts of other interventions. So we've had interest in continuing with benchmarking. We've run a number of successful benchmark groups using AHDB Farm Bench in the past. We've got some groups who want to continue, and maybe others might want to come into those groups. So that provides, if you like, an established way of looking at comparisons across, top, bottom, middle, 25%. This is for, at the moment, it's for arable and root cropping only. If we get enough interest in livestock, we could look at that. But at the moment, we're focusing on cropping. And then we've also got, Brown&Co has put a lot of time and development into labour and machinery planning tools. And we've got a tool that we can bring to the intervention here that looks at assessing how decisions are made around what are large investments in new pieces of equipment. So it might be assessing the options around hiring versus sharing ownership, using contractors, or thinking about system change, links back to collaboration. So we could look at that again for specific, specific requests.
We could also, Greg, I think, probably use this productivity planning tool, benchmarking intervention, to assemble groups. And
yes.
A group of individuals that were, a group of people that knew each other, perhaps that were in a livestock section of part of the country and wanted somebody to help to facilitate, bring this data together for them individually, and then have some cohesive collective discussions. We could use this for that too.
Absolutely, yeah. So the penultimate slide next is just what do we do with all this? So we've thrown, quite a few options out there, and our process really, and again, I'll answer one or two of the questions that have come from the QA as part of this, is that these interventions continue until March 25. The initial point is sort of finding out more information from us, making your choices, and that can be done in a number of ways, really. It can be through talking to the team here, it can be talking to a specific advisor, but once a choice has been made, we can then develop along which track farmers want to go. And I think that initial decision making is really important to get it right. So we're asking that farmers sign up sooner rather than later, so we can start these discussions. There could be options for some farmers to have multiple interventions as well, so it might not just be restricted to one. We're also quite flexible to respond to farmers' needs as well in which bits of interventions we might put together. Our limit is that we need to make it work within a single day of time input, and that comes back to the point around efficiency of information and preparation to start with. So this process will really start now. We're looking to start delivering in the next couple of weeks. So we would encourage people to sign up as quickly as possible. Just on reporting, every intervention will be accompanied by a report. And what we're trying to do in the reports this time is to ensure there are key performance indicators in there that again allows for some form of alignment with industry sort of standards or the top 25% that hope to drive change and to drive potentially improvements in productivity that we're all looking for, because ultimately it will help to build resilience, which is the ambition of the project. I'm going to now look at some of the Q&As while we show this last slide, and the last slide really just sets out the next webinars coming up. So let me just run through some of these Q&As. There's been one which is really a request alongside grants to mention that there is a farming and protected landscape scheme that's available for farmers and landowners in national parks and areas of outstanding natural beauty. That might sit alongside other grant schemes as well.
I can come in there if you want, Greg.
Go for it, Chris. Yeah,
I've learned my valuable lesson now, which is if you're speaking on a live webinar, that you should shut the dog in another room. It's not even our dog; we're dog sitting it. So I didn't know it was going to bark. So apologies for that. The farming and protected landscapes is quite useful actually, because it has a lot of similarities to LEADER, which a lot of people will remember. But LEADER's budget was national and enormous. So government have trimmed that down and made it available only in, as you say, protected landscapes and AONBs, but it is still useful and could actually fund things that you that you wouldn't expect. So I am aware of places in the country where farmers in AONBs have actually got funding for pieces of equipment where they can demonstrate a benefit to the local landscape. For example, if you're farming in a valley with a chalk stream running through it or something like that, and you're changing to a regenerative farming system, you might get some equipment and things through that, and small investments in tourism or diversification can be funded through FIPL, as we call it, as well. Just on those, a lot of the funding that we have had has been around tourism and diversification and so on. And some of this stuff that we've got now is very niche. We are expecting the Rural Prosperity Fund, which is the replacement for Leader, essentially, to open in the spring or later in 2023. So for those of you who are thinking about diversification projects, don't dismiss that grant funding has disappeared, because it might come back for some of those investments. And then allied to that, for any larger diversification projects, we're expecting the Shared Prosperity Fund, which is very similar to the Rural Prosperity Fund, to open late next year, early 2024 as well. So as I was trying to say before the dog interrupted, these grants are not only going to be for technology and equipment, but also some of this other stuff is going to come back online as well.
Just Chris, just to add to that, can you just say something about a little bit about expectation management, I guess, around what we're able to deliver in the project?
Yeah, so I mean, some of the kit we were talking about earlier is phenomenally expensive. So if we can reduce the cost of that, we need to. And Defra have produced these grants for robotics and adding value to agri-food and water resource management so far, and they'll continue to release these things because they've committed to use unspent basic payment on grant funding. So the process has been simplified slightly now. So we have an online checker which you submit, which gets you in the system, and your full application for grant funding follows that. So again, what I was just coming on to say earlier is that we believe that in our day of time, we would be able to complete, an assessment of your investment, do that partial budget, and work out whether it's financially and practically a good idea. And if it is, then we should be able to, or could do in the day, submit the online checker with you as well. But then, of course, we'll probably be out of time with the day by that point.
That would then lead on, wouldn't it? If that's successful and you're in then in the accepted scheme, then full application would be something you'd revisit about.
And I think what this scheme can do, both with grants and also with some of the planning work as well, it de-risks the next step for farmers, because it gets a little bit further down the line, a little bit more certainty, a few more boxes ticked, that enables then the confidence to go to the next stage, which will involve some investment by farmers and landowners themselves. We've got one or two people dropping off now, so I think I'll ask Charles to just make a last comment on this. Before I do that, we had quite a number of questions from the first webinar that we had, which covered a lot of the general points. We'll post those in the chat now, so please do read those. They should answer any other unanswered questions. If you have anything else that you want to ask, please ping us through an email. We're very happy to talk on the phone or respond. We'll be sharing everything here in links to you. And in general, please spread the word. We would encourage, obviously, people to sign up with our offer, because we do think it provides that choice and flexibility with professionals that others don't necessarily offer. And do spread the word about the next webinars as well. Next one coming up on carbon natural capital in 3 weeks' time. Charles, would you like to say last few words?
Well, thanks, Greg, for doing that and putting that on, making all this happen this evening. I think thanks everybody for tuning in and listening. I think the previous phases of this and the previous pilot something slightly different for our normal level of work that we have on farm, but funded by Defra. So we've not had sort of free of charge delivery services before. We've tried to tailor our standard consultancy approach to fit into that, so that we could do so on a cost-effective basis, both to ourselves and obviously from the Defra grant point of view. But I think the vast majority of, I'd like to think anyway, the vast majority of participants that we've had on that, which have been generally new businesses that we haven't been involved with historically, have found them very useful, because we are coming from a position of generally quite good knowledge across the farming spectrum across the country. We're used to relationships with farmers. There's not very much that we haven't seen before, and that's not meant in any sort of positive or negative way, but we are very used to delivering this sort of advisory around farming family kitchen tables, dealing with succession challenges, dealing with relationship challenges, and all the things that happen in farm businesses, and particularly perhaps when there's some stress around volatility of markets, different impacts on P&L accounts, and shortage of cash. And we certainly feel we're going into a period of different returns for agriculture, not all better, but generally I would say the whole sort of tide has lifted, but also has the cost of operations, the capital involved, and therefore the risk. And so I think this is well timed, this intervention. Things have turned out. None of us could have predicted the awfulness of Putin, obviously, in his nonsense, but I think it has changed many businesses' outlook, and needs to, because of the vast increasing costs of production that have crept up on us this last 6 or 8 months. And that means that we need to be considering change, all of us really, because things have changed substantially on the ground. If the market can't pay that return anymore, or if the risk is too great, or maybe we can't pay the rent anymore because the rent's the wrong level, this will help people come to terms with that and help make decisions and choices about the future. Thank you.
Good. Thank you, Charles. Thanks everybody for listening, and we look forward to hearing from you soon or seeing you on the next webinar. Thank you all very much.